Welcome back. You're watching Investors Guide. Remember, we are talking about the portfolios that we designed a couple of years ago for different age groups. The last portfolio that we're looking at is the one designed for a 65-year-old or someone who is already retired. Dhirendra Kumar designed these portfolios and we've been investing in them regularly, hypothetically, for the last couple of years. And we've been tracking this investment. This portfolio, like I said, designed for someone who requires a regular income. These are the funds that we've invested in: the FT India Dynamic PE Ratio Fund of Fund, the HDFC MIP, the Reliance MIP and the UTI Balance. Now this portfolio is a little different from the other portfolios that we designed. This one does not involve a regular SIP because you're talking to someone who's already retired. What we expect you to do is to put in a lump sum, and we'll expect you to pull out a certain amount of money every quarter so that it pays you that regular income. From the looks of it right now, are you happy with this portfolio? Would you like to make any changes?
Yeah, I am very pleased with the performance of this portfolio. Here's a portfolio which was constructed that you invest 10 lakh rupees and you take out 20,000 rupees every quarter, which means effectively you take out 80,000 rupees in a year, which is 8% withdrawal rate. And after that, if it is able to deliver, and your capital value, if it is still higher and reasonably higher, I think one is able to achieve that. It's quite comforting. More so after the decline of the market. Don't look at this portfolio, your 80,000 rupee withdrawal from an investment of 10 lakh rupees as your primary income basis, something on which you bank on. It should be used as a supplementary income portfolio because what we have done here is a less periodic, a quarterly withdrawal of 5,000 rupee from each of the fund, and I think it has done exceedingly well. It is little aggressive with its allocation though. It is 40% into equity right now, 60% into fixed income, but the dynamic fund is doing the job in the sense that at the peak of the market in December, in a recent peak of the market in last December, this fund had a lower equity allocation. Today it is marginally higher. So this fund, this particular portfolio will also benefit from the movement, the level of the market and the periodic realignment.
So that is our final portfolio, the income growth portfolio, which is flashing on your screen. If of course you need any more details, you can write to us as an email ID at the bottom of your screen. One last question before we wrap up this show. Mr. Shah has written in. He tells us he's a retired engineer. His income source is from dividend of equity shares in mutual funds and company fixed deposits, and of course his savings account interest, he tells us. Now he says his total income is approximately 2 lakh rupees, which is tax free. His investment in the Post Office National Savings Scheme is at 4 lakh rupees at 7.5 interest, and he tells us this 7.5 interest that he's getting is reinvested, so he doesn't withdraw any money from it. He wants to withdraw the money from the National Savings Certificate and invest it in the Senior Citizen Savings Scheme that gives him 9% interest. He wants to know, does that make sense to do right now? The other interesting thing for someone who's retired to consider is that 9% interest from the Senior Citizen Savings Scheme can also be got from a fixed deposit at this point. So which one would you recommend for Mr. Shah? Should he be pulling his money out and putting it into the Senior Citizen Savings Scheme or into a fixed deposit?
I would say that, if he really wants to be very passive about it, the Senior Citizen Savings Scheme is reasonably rewarding. Though today you will have, senior citizens might derive slightly higher return from fixed deposit, but the fixed deposit will not have 15-year term. Also, the fixed deposit will not get you the ATC benefit which you will get in this. So, today Senior Citizen Savings Scheme has become eligible ATC investment. So, in that sense, but you will get that advantage only in 1 year, and also more so because you don't have any meaningful income. You just might be able to manage as you are deriving a good part of your income by way of dividend, which is tax free, or capital gains if you are realizing anything from your stock. I would say that you want to be passive about it, choose the Senior Citizens plan. You want to be a little venturesome, then maybe NSS certainly, because it is a lower return than what is available elsewhere from similar sovereign guaranteed fixed income avenue. So I would say that certainly pull out of that and be venturesome or be conservative. It entirely depends on your own preference.
All right, Mr. Shah, so that's the advice that's going out to you. Remember, you can, of course, pick the Senior Citizen Savings Scheme if you want to be conservative. Devendra Kumar, thank you so much for coming in and answering our questions. We will, of course, continue to track these portfolios on a regular basis, and we will be updating them regularly. Thank you for watching Investors Guide. Remember, write to us, email ID at the bottom of your screen. Thanks for watching. Tune in next week to catch Investors Guide.